In our view, there are three main considerations for investors when choosing an ETF. Number one, the benchmark index. Number two, the fund size. And number three, the structure of the fund. Let's start with the index. This might seem an easy step, but there are more than 1.5 million indices out there. Investors should think about the index that allows them to better express their portfolio views. For example, to gain exposure to European equities, the Euro Stoxx 50 is a good solution, as it covers 50 of the continental Europe's largest companies by market capitalization. But if you want to increase diversification, the MSCI Europe might be more suitable, as it is made up of over 440 constituents. Meanwhile, the MSCI EMEA allows you to remove exposure to the UK if you want to concentrate on the continent. The asset under management of an ETF is known as the AUM, and it is important in relation to the efficiency of the fund. Passive investing or index investing is a scale business in that large funds help keep costs down for investors, as economies of scale kick in and the fixed cost of running the fund can be minimized. In addition, one of the most important aspects of ETFs is their liquidity. Liquidity simply means how easily an asset can be bought or sold and how quickly the proceeds of the sale can be converted into cash. Liquidity is important as investors want to be able to buy or sell investments quickly and cheaply during the stock exchange's opening hours. The larger a fund is, the more liquidity it will have, leading to narrower spreads, i.e. a smaller difference between the price at which you can sell the fund and the price at which you can buy it. Larger ETFs, in general, have lower trading costs. Ultimately, it is about the tracking experience of the investor. Indices are intellectual objects that don't exist. When using a financial instrument to gain access to them, costs will have to be paid, and there might therefore be a slight difference between the return of the index and the return of the fund. Minimizing those differences, those drags, by keeping costs down and choosing an established and experienced ETF manager is key. In Europe, ETFs can replicate an index by purchasing all or a subset of the index constituents, such as shares for a FTSE 100 ETF. This structure is called physical replication. An investment management company can also deliver the index performance through a different setup, known as synthetic replication. This is slightly more complex to understand. Instead of holding the underlying shares, these ETFs use financial engineering to achieve the desired results. Synthetic ETFs use derivatives such as swaps to track the underlying index. The two setups have benefits and limitations. For example, the physical setup is transparent, safe, and easy to understand, but doesn't work for certain indices, for example, commodities. The synthetic setup is very useful in those cases, but there can be additional risks because of its use of derivatives. To wrap up, there is an amazing breadth of opportunities in the ETF space, and due diligence is important. Today, we have covered three key aspects investors should always consider.